They said housing prices would never drop. They said demand was too high, supply too low, and homeowners were stronger than ever. But if history has taught us anything, it's that markets don't whisper before they break. They stay quiet, confident, and euphoric right until the moment they crack. And the housing market is now more fragile than it looks on the surface. The warning signs aren't coming from mainstream headlines. They're buried in bank earnings reports, bond yield spreads, foreclosure data, and insurance industry disclosures. While most people still believe housing is a safe bet, the smart money is quietly repositioning. The next housing collapse won't look like 2008, but it could be just as brutal. Let's start with the fundamentals. The cost of owning a home in America has never been higher relative to income. Median home prices have soared, while real wages have stagnated. Mortgage rates have doubled since 2021, pricing out millions of would-be buyers. And yet prices haven't crashed. Why? Because the market is artificially frozen. Sellers don't want to let go of their low-rate mortgages. Buyers can't afford the new rates. So inventory remains tight, but demand is exhausted. It's a standoff, and standoffs don't last forever. Eventually, someone breaks. One of the first cracks is forming in the short-term rental market. Thousands of Airbnb and vacation property owners bought homes in the boom using easy credit and overestimated demand. Now, bookings are down, revenues are falling, and many of these owners are over-leveraged. As they begin to offload properties, local markets could be flooded with inventory all at once. Commercial real estate is already collapsing in slow motion. Office buildings in major metros are empty, overfinanced, and underperforming. And while commercial and residential are separate sectors, they share the same financial backbone: banks. As defaults rise in commercial loans, lenders get stricter with residential credit. Liquidity dries up. Margins shrink.
Contagion spreads.
Meanwhile, property insurance costs are exploding. In states like Florida and California, premiums have risen so sharply that some insurers have pulled out entirely. Without affordable coverage, home ownership becomes more expensive, or even impossible, in risk-prone regions. That puts downward pressure on property values, especially in areas that once thrived on migration and speculative growth. Then there's the hidden inventory. Zombie homes, properties that are technically off-market but not truly occupied or viable. These include delayed foreclosures, homes caught in probate, and rentals that landlords can't move. They're not counted in the official supply numbers, but when financial stress increases, they will be. And when they hit the market, they'll weigh heavily on prices. Home builder sentiment is also declining. After a short-lived surge in 2023, many builders are pulling back again. Permits are falling. Labor costs are rising. Material costs remain volatile. Builders are starting to realize that demand isn't as deep as it seemed. It was just a temporary spike fueled by FOMO and government stimulus. Institutional buyers, once the biggest force propping up housing demand, are slowing down too. BlackRock, Invitation Homes, and other large players are no longer buying at the same pace. In some markets, they've begun selling. When the biggest whales start exiting, it's not a blip, it's a signal. And we haven't even talked about the debt ceiling. If the U.S. government loses control of its fiscal policy, interest rates could spike even further. That would make mortgages even less affordable and force a repricing across the entire housing market. What looks expensive today could look wildly overvalued tomorrow.
But perhaps the most overlooked risk is psychological.
Housing markets run on emotion. Buyers fear missing out. Sellers fear leaving money on the table. And investors fear holding the bag. Right now, sentiment is brittle. It's held together by the belief that prices can't fall. But that belief is being tested more each month. When the narrative breaks, panic can spread faster than any data point. We saw this in 2006. Prices remained elevated long after fundamentals broke down. Everyone thought the market would correct slowly. Then it collapsed suddenly. Not because of one single event, but because belief evaporated. Once the illusion of stability shatters, everyone rushes for the exit at the same time. Now, imagine that happening in a world where liquidity is tighter, inflation is still lingering, and institutional buyers have already pulled back. The correction could be swift, not because there are more sellers than buyers, but because there are suddenly no buyers at all. Even government interventions may not be enough to stop it. Rate cuts take time. Stimulus checks don't buy homes. and foreclosure moratoriums only delay the inevitable. If the collapse begins, policymakers will scramble, but by then prices could already be down 20 to 30% in vulnerable regions. This won't be a nationwide wipeout. It will be regional but violent. Overbuilt suburbs, speculative Sunbelt cities, and coastal markets with extreme insurance costs will be hit first. Then the pain will spread outward. Safe doesn't mean immune. And renters won't be spared either. As landlords face higher financing and maintenance costs, they'll either sell or raise rent. If they can't do either, they default. That reduces available housing stock and puts more pressure on local markets already stretched thin.
So what does preparation look like?
First, stop assuming housing is invincible. Look at your local market with clear eyes. Study the price-to-income ratios. Look at rental yield trends. Pay attention to insurance changes. These are the leading indicators, not the headlines on mainstream media. Second, don't over-leverage. If you're buying, make sure the numbers work at higher rates and lower comps. If you're investing, diversify beyond housing. Tokenized assets, digital infrastructure, and productive farmland may offer better long-term stability. The third area was behavior of big players. If institutions are pulling back, follow that signal. They have access to data most retail investors never see. When they move, it's not emotional, it's strategic. Fourth, understand that housing is no longer just about shelter. It's financialized, it's politicized, it's entangled with insurance, regulation, credit policy, and capital markets. To navigate this, you need to think like a systems analyst, not just a homeowner. And fifth, be prepared for the unexpected. The next wave won't look like the last one. It won't be triggered by subprime loans. It may be triggered by liquidity mismatches, insurance shocks, or a sudden loss of confidence. Whatever the trigger, the result will be the same: rapid repricing, followed by a scramble to reassess what homes are actually worth. If you want to stay informed, protected, and ahead of the next housing shift, subscribe to Wealth Signal. We break down the real forces behind the headlines and show you where the smart money is moving before the rest of the market reacts.
Because once the panic starts, it's already too late to prepare. But right now, it's not too late to position.
Look at the trend lines, not the headlines. Real estate cycles don't move overnight, but when they do accelerate, the damage is already done by the time most people notice. If you're paying attention now, you have time to act with clarity, not fear. The smartest investors aren't guessing which zip code will go up next. They're repositioning into more agile asset classes. They're investing in on-chain infrastructure, income-producing alternatives, and flexible capital models that don't rely on old real estate assumptions. This isn't about doom. It's about discipline. And it's about seeing the housing market as it actually is, not how it's been marketed to you. Understand the moving parts. Track the silent signals. And stay light enough to pivot when the cracks become undeniable. Because this time the correction won't be about broken loans. It will be about broken assumptions. And those who see it early won't just avoid the fallout. They'll be the ones buying when the market finally resets. If you found this perspective valuable and want to stay ahead of the shifts that most investors never see coming, subscribe to Wealth Signal. We reveal what the smart money is doing, decode real market signals, and help you position early before the headlines catch up. Don't wait until it's too late. Align now.